From New York City for our viewers worldwide, I'm Lisa Abramowicz in for Jonathan Farrow. A softer tone for day two, led by the Nasdaq. The longer the session goes, the more the losses build. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, investors are cautious ahead of Powell's congressional testimony. Global central banks feeling the heat as UK inflation surges to a 31-year high. And as Tesla's world, we're just living on it. We begin with the big issue, all eyes on Powell.
We've got Jerome Powell.
Powell's testimony on Capitol Hill.
Powell has a tough job.
They didn't do themselves any favors, frankly, skipping.
He has a split view on the Hill.
There will be questions about what makes you up your hikes again.
He definitely needs to sound hawkish at the testimony.
He needs to be a bit hawkish.
As hawkish as possible.
He's going to strike a balance, perhaps a little bit on the dovish side.
He's going to have to sell, yes, we can get inflation down, but without a major recession coming.
Can we get a bit more clarity on the message from last week?
It's been a communication dropping of the baton here, and we need to get it back in line.
Powell was unwilling to commit to July.
I'm very curious to see how the market reacts when Powell speaks.
If he pulls this off, it'll be unprecedented for a Fed chair.
Joining us now is iCapital's Anastasia Amoroso and Morgan Stanley's Brian Weinstein. Thank you so much for being with us. Anastasia, what are you expecting to hear from Jay Powell? Is he going to be doing a cleanup job than what we heard last week?
Well, I think so, Lisa. I mean, the message that he really delivered to the markets last week is that we're making progress on inflation, but we're not quite done. And I think what the markets really heard is the first part of that sentence, which is we're making progress and the conditions are in place and we're close to our destination. And I think he did a really good job delivering that message. And again, it resonated as the markets rallied. But now he may want to focus really on the second part of that message, which is the part where we're not quite done. I mean, inflation in the U.S. is 4 or 5%. It is not yet on pace to 2%. And so I think he may reiterate that may require some more tightening. And at the very least, it's going to require us keeping 5.25% for a prolonged period of time. So I would, as a lot of the speakers just said, I would expect a hawkish tilt to this for sure.
Brian, what are you looking for today?
You know, I think Powell did what he wanted to do last week. I think he was intentionally, I guess, hawkishly vague. He wants to hike, but they really want more time, Lisa, right? They don't want to do anything at all. I think to have no dissents in that meeting, he promised that he would speak hawkishly, and that July was in play. But if you look at the market's reaction, I think it's not far from what they wanted. The market's pricing in a soft landing. It looks pretty good. So he'll be hawkish, but I don't think he'll break any new ground.
Well, this is the surprising aspect to me. They have the market convinced that they are going to raise rates and hold them there for longer. There's a pricing out of rate cuts later this year. There's been 100 basis points of an increase in two-year yields just since early May. Anastasia, why have risk assets continued to rally even in the face of a hawkish prognostication and a belief in markets?
Yeah, I think it's two reasons. It's first of all positioning and this chasing that we've been talking about. And second of all, it's this belief in economic activity and that it continues to hold up. And I think both of those things are credible. You know, it's great that investors have been adding risk here. They hopefully have benefited from this rally. And at the same time, we know the U.S. economy is holding up thanks to the consumer. We got the retail sales last week, for example, kind of confirming that. So I think there are really good reasons. And Lisa, it also speaks to me that there is some constructive developments in this market, as despite the fact that we priced out all the rate cuts that we previously priced in, the market is rallying. So that does tell you that there's more to it than just us trying to bet on the Fed cutting rates. So I find that to be a constructive development. Now, having said that, the positioning and the chasing is no longer likely to be the big tailwind that it was for the last 6 or 7 weeks. And that's why, as you know, things go parabolic. They don't do so in perpetuity. If the right catalyst comes along, they tend to correct, at least partially. And I think we're looking at a catalyst this week, which is potentially hawkish Fed Chair Powell.
Well, Brian, do you agree that the signal from equities, from risk assets, from riskier securities in the bond space rallying even in the face of higher yields is actually constructive? Or do you think that this is the ostrich syndrome of people hiding in the sand?
Well, Lisa, when I look at where to hide, I mean, we've all spoken about cash ad nauseum, right? Investors are speaking with their wallets. 5% is great in the front end. Long forwards in risk-free rates are in the mid-threes. I just don't think it's high enough. So I think investors are happy to take 5% on one end of the barbell. But when I look at 10-year treasuries, I don't think it's not high enough yet. So it doesn't surprise me that given earnings are holding up, we seem to be getting some rebound in economic activity, housing, other places, consumer is okay. I'm surprised the yield curve hasn't bear steepened if they want to challenge the Fed until we get higher yields on the longer part of the curve. I think people continue to buy risky assets.
Well, exactly to that point, Brian, we heard from Mohamed El-Arian. He wrote a column earlier this morning, the president of Queen's College in Cambridge and formerly of PIMCO. He wrote, the implications extend beyond Britain in a multifaceted way. He was talking about the UK inflation rate. Today's UK data serves as a reminder to all that there is a real cost of falling behind in the inflation battle, and one that increases over time. It erodes the credibility of policymaking when it's already struggling to respond to more complicated problems. From your vantage point, Brian, is this what you're looking for? Basically, people saying, okay, maybe they're not that serious about fighting inflation, and to start pushing up the yield in the long end to indicate something that creates a bit more pressure.
Yes, I mean, when we get to minus 100 on the yield curve, which is 2/10s around where we are, 90 or so, it's historically very, very flat, and you wonder if the market wants to push back on the Fed, if Powell's testimony is not hawkish enough, if the Fed meeting didn't do enough for the market, where is that risk premium, right? That's what could challenge risk assets, give investors a real alternative out the yield curve in fixed income. It's just not there. I do expect if we get any strength in the data to continue here, that we're going to start to test that, and we're going to see if this Fed really does want to hike rates or not.
Anastasia, from your vantage point, do you agree that if 10-year yields start to rise, if people's longer-term inflation expectations and rate expectations rise, that will be the game changer for risk assets?
I think it would, Lisa. That's one of the big reasons why tech had the rally that it had earlier this year, is because of multiple expansion as the 10-year yield was declining. I mean, I do agree that if the 10-year starts to rise, we're now repricing the longer-term inflation expectations. And fortunately, in the United States, what we've been recently repricing is the growth expectations. That's what drove the 10-year yield from 3.4 to 3.7%. But to the extent that the 10-year starts to rise because, all of a sudden the inflation expectations start to become more entrenched, that would certainly cause a problem for risk assets. And, to kind of go back to the point, Lisa, you were making about the UK CPI, I mean, it is stunningly high, but I also think it kind of showcases how the Fed has actually done a good job of getting ahead of the curve finally. I mean, if you look at the UK, you've got the inflation rate at 8.7% and their Fed funds rate equivalent of 4.5%. Now, that means that the rate is below the rate of inflation. That's not the case anymore in the United States. And the Fed at 5.25%, 5.5%, that's over and above the core PCE inflation of 4.7%. So that, to me, really sort of demonstrates that the Fed actually has finally done a good job of getting ahead. And I think that notion will give the Fed the opportunity to pause over time. And for investors, global, seeking to allocate to global equities, that's why they're going to continue to prioritize U.S. equity.
Well, we will hear from Chair Powell. He will be in the hot seat today. He is heading to Capitol Hill. His semi-annual testimony before the House kicking off in about 52 minutes' time. This is President Biden's Fed nominees are set to face the Senate Banking Committee as part of their confirmation process. Joining us with the intel and the prepared testimony so far, Bloomberg's Michael McKee here on set. Michael, what have we learned from the testimony? What are we expecting to hear?
We haven't really learned anything, Lisa, because as the late, great Yogi Berra once said, maybe, it's deja vu all over again. Basically, a cut and paste job of his opening statement at the news conference last week, in which he promised the Fed is going to do more, maybe. Here's the key quote. Inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. And he cites a tight labor market, a very tight labor market, inflation well above their longer 2% longer run 2% goal. They are seeing some tightening affecting rate-sensitive sectors, but the extent of the effects remains uncertain, and he promises they'll make decisions meeting by meeting, which leaves open this question. Will the Fed be raising rates? Will they raise in July? Do they raise in September? What do they do? Since they don't know what's going to happen to the economy, you can see the change in the dot plot here. The yellow is the new, the white the old, and on the far left there is how much they have moved up. Now, that's what comes out in the summary of economic projections, what each individual member thinks is going to happen. But there's still a lot of people who think that don't need necessarily to go much higher. So the job of members of Congress today is to try to tease out from Jay Powell whether they do indeed plan to raise rates, and if so, when, and how high does he think they are going to go. Of course, he doesn't want to tell them that, so it's going to be an interesting standoff, and we'll see what they have to say.
Michael McKee, thank you. And of course, one of the key questions will be how much do people actually care? Anastasia Amoroso and Brian Weinstein still with us. So, Anastasia, I pose that question to you. Are you paying attention to any of this, or has this moved into the background, especially as the Fed doesn't have any better intel on inflation and the path of what paradigm we're in right now than any of the rest of us?
Yeah, I mean, of course, we have to pay attention to the Fed because, to the extent that they've become a tailwind to valuations, that can flip very quickly. And if the Fed goes back into more meaningful tightening mode, it can become a headwind to tech valuations. But the reality is between now and July, the Fed is going to be watching every single data point. And I expect that the probability of a rate hike is going to be all over the place between now and then. But I think some of the key variables that will ultimately have them decide whether they're going to hike or not will be things just indicating the strength of the U.S. economy. So, let's say inflation is continuing to, move to the downside, but you've got payrolls that are still coming in strong. You've still got wage growth that's running over 4%. If you have the GDP for the second quarter continuing to track at 1.8% or higher, I think they're going to look at that and say, well, that tells us the U.S. economy is strong enough for us to hike in July. So I am paying attention, of course, to the data points and the Fed. But again, what's most encouraging to me from the sustainability of the rally perspective is that the U.S. economy continues to surprise to the upside.
Brian, to that point, how concerning was it from the Fed's vantage point that we saw housing data yesterday that was incredibly strong? The one area that was supposedly interest rate sensitive, that was supposed to be on the decline, actually seeing a resurgence.
Yeah, fascinating data point, and we have to see more to figure that one out. But if you look at, on one side, initial jobless claims starting to tick higher, which is always a bad sign. And then you look at housing, which is supposed to be interest rate sensitive, and it seems to be much more resilient than anyone expected. To your previous question, the Fed, I think, wants to be in the background. They don't know what to do. They're not giving us anything new. They could give us another data point to look at. They could use the balance sheet as a tool to steepen the yield curve if they wanted more risk premium. They're not doing anything. So I think it's hard to look at the Fed for signs. We need to look at the data. We need to look at earnings. And so what does the Fed hike in July or not? I don't know that it matters so much, except as a signaling mechanism that the 25 basis points isn't the problem. It's whether or not they're right? To Mohamed El-Arian's point, if this is a resurgence in growth and inflation is sticky, it's going to look like a giant mistake, and we just won't know for a while. So we need to let the markets sort this out and see some more data.
Both of you are sticking with us, Anastasia Amoroso and Brian Weinstein. Now let's take a look at what's moving ahead of the opening bell here. Abigail Doolittle is joining us here. Abby.
Well, Lisa, with the futures down modestly, we do have one big stock that is dragging, and right now that's NVIDIA after its 200% run this year, with the year not even halfway through. Some analysts are protesting. In fact, Lynx Equity Securities saying that the rally is overdone too far, too fast, that it's not sustainable. If this analyst is right and the parabolic uptrend collapses on itself, it will come back out of that $1 trillion club. Coinbase Global is up 2.6%, popping with Bitcoin, but they're also wanting to enlist Congress to pass crypto laws that could, in fact, impact their fight with the SEC. And then FedEx down 3%. The parcel company gave a 2024 forecast that is below analyst expectations. The fourth quarter revenue lagged consensus, tough macro overall, kind of a messy quarter, and the third one in a row. Lisa, that stock down 3%.
Abigail, thank you so much. Coming up, Western allies commit to further economic support of Ukraine.
Recovery is about laying the foundation for Ukraine to thrive as a secure, independent country, fully integrated with Europe, connected to markets around the world.
That conversation coming up next as leaders meet in Europe to discuss the rebuilding of Ukraine following the conflict. This is Bloomberg.
Today, I'm announcing that with the support of the United States Congress, we will provide more than $1.3 billion in additional aid to help Ukraine. We're going to invest over $520 million to help Ukraine overhaul its energy grid, more than half of which, as you've heard, has been destroyed by Russia. And in so doing, make it cleaner, make it more resilient, make it more integrated with Europe.
Western leaders pledging their continued assistance at the opening of the Ukraine Recovery Conference. UK Prime Minister Rishi Sunak unveiling a framework for private investors to underwrite reconstruction efforts, calling it a, quote, huge step forward towards helping insurers to underwrite investments into Ukraine, removing one of the biggest barriers and giving investors the confidence they need to act. Meanwhile, U.S. Secretary of State Antony Blinken pledging an additional $1.3 billion in assistance to help rebuild Ukraine. Bloomberg's Maria Tadeo joining us now with more. Maria, it is sort of odd to be talking about the reconstruction of Ukraine at a time when, by all reports, it seems like the conflict is accelerating. Can you pair these two realities?
Yes, and it is a difficult one because we know that on the ground the fighting continues, and as you say, it has probably accelerated because of this counteroffensive with the Western allies today in London. The UK is hosting this conference. What they argue, however, is that the job is so big you have to start preparing already for it, and we've seen new money today promised by the United States, the UK too, and that is on top of the 50 billion euros that were promised yesterday by the European Union until 2027. The issue here, well, there's two. One is they all say we stand with Ukraine. We want this to be a democratic country, vibrant democracy, and a strong economy. But the problem is, if you're still fighting a war, how can you do that? And also, when you look at the assurances and the security that companies want to see, well, they want to see a very clear security framework for the country. And that is not obvious either, because Ukraine still believes they will one day join NATO, but that is not clear by any means. So the security guarantees, that is also very connected to the economic security of the country. But the answer as to what that consensus looks like, that is still very much up for debate.
Maria, just quickly here, how much are European leaders in particular counting on the rebuilding of Ukraine to inject a new leg of growth in their economy?
Look, it could be. And remember, Ukraine has also applied for membership of the European Union. So this is very tight. This is their big aspiration when it comes to foreign policy, to one day join NATO, but also politically and economically entered the European Union, which usually then follows joining the euro area. And that means also the euro. But this is a long way to go. We should be very clear. This is a very long journey for countries, especially in the condition of Ukraine, fighting a war to join the European Union. At this point, could this be a growth accelerator for the European Union? The reality is it is not. Could it be one day? That depends on how the war goes. But for the time being, the European Union is clear. They themselves now have to help Ukraine. And we go back to that 50 billion euro plan that was announced yesterday.
Maria Tadeo, thank you so much. And we'll be catching up with you over the next 24 hours with your fabulous conversation on deck from the Prime Minister of Ukraine. Still with us, Anastasia Amoroso and Brian Weinstein. Very glad to have you back to talk also about the European question at a time where the ECB clearly has more work to do. And there does seem to be resilience there. Brian, do you feel that this is an area worth investing in, even in some of the riskier securities, because of the promise of growth that has been more resilient than many people imagined?
Yeah, Europe is always a little bit trickier, but the ECB does seem more hawkish than the Fed. They seem to have a bit of a better handle on their message. I think the counter trend or the thing to worry about there is a little bit China, right? I think the weakness in China is weighing on certainly German growth, which has often been the kind of driver of Europe. So I think there are some cross currents, but we find plenty of risk assets in Europe that we like. We have no issue investing there. Again, with the ECB doing a better job, I do think there are lots of opportunities. And the growth that does seem resilient.
Including AT1 bonds and some potential riskier bank securities in Europe, Brian?
No doubt. I mean, yes, we've played it. We've played at AT1s. I mean, listen, there's a big wake-up call. I think fixed income folks probably were aware of the risk of those securities, but the baby gets thrown out with the bathwater. So there are plenty of great institutions in Europe. It's a very common funding mechanism. There are plenty of bonds out there that you can buy, and so we continue to traffic in AT1s. I mean, not every single one, but it's a place where you'll find us taking risk for sure.
Anastasia, you as well?
I mean, I probably diverge a little bit on this view because I do think whether you look at the UK markets, whether you look at the European markets, you've got central banks that have not quite done enough to bring down inflation when you compare and contrast that to the United States and the Fed. So, and just using UK as an example, because we were thinking about it this morning, you look at the UK market and you've got 60% of the market that's in things like financials and staples and industrials and materials. And those are not likely to be the sectors that lead when you have, close to flat GDP growth. And so I do like parts of the European markets and the UK markets, but I actually think investors may want to look to private equity and private markets in both Europe and the UK. And I say that because, while the indices are still comprised of some of these cyclical older industries, when you look at what the private equity managers are investing in, they are investing in growth. They're investing in tech, whereas tech is only 1.8% of the UK benchmark. But those private equity managers are investing in TMT and SaaS, software as a service, and new age industrials. So I actually think for investors that don't want to give up on the region, nor should we, I would look to private markets as an interesting opportunity here.
Brian, do you agree that private markets hold that kind of promise?
We continue to see great demand in private credit, and yes, sure. In Europe, it's a little bit more fragmented, a little bit more it's more difficult because you have to actually understand the jurisdictions, all the places you're in. But yes, we love private credit and private equity. There's plenty of growth in Europe, and I do agree. The UK is a unique case. That economy seems to be struggling with unique growth pressures, along with unique inflation pressures, and maybe of the three central banks we've mentioned, the one with the weakest message. So that might be a place where there'll be opportunity, but it's a bit more volatile. But we love private markets, lots of opportunity there. By the way, the public loan market in the U.S. and Europe actually has not gotten a lot of love this year. It's been out of vogue. So there are actually some public loan opportunities that investors can access as well.
Anastasia Amoroso, Brian Weinstein, both of you, thank you so much for being with us this morning. Coming up, the morning calls, and later, Patrick Frazzetti of Rose Advisors at Hightower joins us around the opening bell. We are seeing a softening ahead of the open. From New York, this is Bloomberg. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, BMO Capital upgrading Adobe to outperform with a price target of $570, seeing the company gaining new users through generative AI. Next up, Oppenheimer raising its price target on Uber to $65 from $55, keeping an outperform rating. The analyst citing increased confidence in the company's consumer tailwinds. And finally, Wedbush raising its price target on Chipotle to $2,300 from $2,200, keeping an outperform rating. The analyst viewing a margin expectations as conservative. Right now, conservative expectations for the open as both the NASDAQ and S&P lower ahead. You could see led by the NASDAQ down 0.4%. Patrick Frazzetti up next. This is Bloomberg. Are we seeing the beginnings of a pause in some of the AI enthusiasm that's really driven an incredible rally? NASDAQ down 0.4% ahead of the open, which might mark, if it lasts, the second straight day of losses after 8 straight weekly gains. We see S&P futures lower by 0.3%. Over in the bond space, you are seeing a bit of yields higher across the board, particularly on the front end, but even on the long end, 3.77% rounded up on the 10-year. A bit of euro strength, but that's really been fluctuating pretty much flat. Crude also flat, trying to get a handle on how to position ahead of a Fed chair who is going to take the helm in the House to try to discuss what the path forward is for Fed policy. One stock to watch at the open certainly is FedEx, certainly following their earnings call yesterday. The shipping giant's fourth quarter sales missed estimates. 2024 forecast also falling short. Executives saying operating results, quote, declined due to lower global volumes, partially offset by decreased expenses and higher U.S. domestic yields. Joining us now, Abigail Doolittle. Abby.
Well, Lisa, yeah, a bit of a messy quarter here. And it, of course, has to do with the fallback coming out of the pandemic, because during the pandemic, there was a shipping boom as folks were buying everything online, all of those shipping services needed. Not so much. Now, the company right now is really trying to avoid what they did last year, which was withdraw their full year earnings forecast. So in 2022, the CEO came in and implemented, a new CEO came in and implemented a $4 billion savings plan. That is still the case, and now they're trying to look to save another $2 billion. So they've actually cut 29,000 U.S. jobs over the past year. And as you mentioned, the 2024 profit outlook, it's fallen short of analysts' expectations. Some analysts, including Morgan Stanley, saying that they expect the demand to continue to be weak as folks really aren't buying as much online. The stock, interestingly, is well off of last year's lows, but not surprisingly, it's still off the recent peak by about 26%, as investors are not convinced that this company is quite out of the woods in terms of being able to deal with a normalization of its shipping business coming out of the pandemic, Lisa.
Well said, Abigail. Thank you so much. Sticking with FedEx, Evercore ISI lowering its price target on the stock to $275 from $282. The analyst citing earnings guidance below expectations with, quote, flat to low single-digit revenue growth, representing a cautious macro backdrop. Turning to tech, Microsoft CEO is set to appear in court this week to fight for the company's Activision Blizzard takeover deal. The Federal Trade Commission arguing the acquisition will hurt market competition. Microsoft saying, quote, this deal means more choice for gamers, a fact that only becomes clearer the more you look at the case. Katie Greifeld has more, our preeminent gaming expert. Katie, what do you have?
Big time. Well, Microsoft and Activision, both CEOs heading to court in California this week. The 5-day hearing kicks off in San Francisco tomorrow over, as you said, the FTC's effort to block this $69 billion deal. Just to set the scene here, should this go through, should Microsoft acquire Activision, it would instantly become the third largest game maker in the globe. So as such, you have the FTC arguing that this deal is going to hurt competition, particularly when it comes to console and cloud gaming markets. So in addition to Microsoft CEO Satya Nadella, we're also expected to see both the CFOs of Microsoft and Activision appear in court. And it's unclear when we're actually going to get a ruling. It could come as soon as this hearing wraps up. But remember, the deadline to close this deal is July 18th. So the clock is definitely ticking here, Lisa.
Katie, thank you so much. Turning to electric vehicles, Barclays analysts saying Tesla shares have rallied, quote, too far, too fast, thanks to the AI frenzy and the excitement around its supercharger network. The analyst writing, quote, while we aren't surprised that the stock has participated in the rally, we believe it is prudent to move to the sidelines. Ed Ludlow here with us for more. Ed.
Yeah, good morning, Lisa. Dan Levy calls the rally too sharp. He notes that the May's 24% gain and June's 35% gain were driven by two catalysts, as you note. One, the broader frenzy around artificial intelligence and Tesla's prospects in that respect. And more recently, in the month of June, the domino effect of Ford, General Motors, Rivian, and the charging companies all pivoting to the North American charging standard technology, Tesla's technology, for charging. So Dan Levy writing it's prudent to sit on the sidelines for now. Curiously, though, he raises his price target on the stock to $260 from $220, noting that the factors that comprise their 2030 call and the multiples that they assess this stock on are changing and expanding. In other news, Cars.com has put out its American-made ranking of U.S. vehicles, Lisa, and Tesla's Model Y, Model 3, Model X, and Model S take spots 1 through 4, respectively. It's the second time that's happened. Not doing too much to support the stock. We're down or basically flat, but still trading near September highs.
And still up some gazillion percent so far this year. Ed, thank you so much. It's a different story for Spotify, the streaming platform getting an upgrade to outperform by Wolf Research. This, as it reportedly plans a new premium tier with high-fidelity audio and expanded options for certain subscribers. Sounds expensive and something that my household may end up with. Isabel Lee joining us now with more. Isabel, what's the latest?
Hi, Lisa. This more expensive subscription premium is internally dubbed as SIP Premium. So it's expected to launch this year, at least in non-U.S. markets. So this, of course, is in a bid to improve the revenue of the company as investors appease the company to increase its subscription prices. Profitability has been the name of the game in Spotify. The company has been trying to increase its profits. This year, it reduced its headcount. It also has been letting high-profile podcast deals last and also has been looking to sublease its New York office. Spotify first announced this product in 2021, but it put it on the shelf and delayed the rollback when Amazon Music and Apple Music also launched the same product for free. So that's really fierce competition in that space. Still, there's optimism in the future. Wolf did upgrade Spotify to outperform with a 21% increase in price target, and Bloomberg Intelligence calls the new feature clever. Year to date, Spotify has gained around 100%. Lisa.
Isabel, thank you so much. Patrick Fazzetti of Rose Advisors at Hightower playing defense in this market, writing, quote, expect some pressure in markets the months ahead as the market prices in more rate hikes. Gold has done well during deflationary and inflationary periods where there is sovereign credit risk. I believe we have that risk today. Patrick Fazzetti, I am so pleased to say, joining us now. Patrick, before we get to gold, and that perhaps it does present the best defensive bet right now, what do you view big tech as defensive, that trade? Do you view that as having any credence?
I really don't, because what's driving big tech today is AI. And you look, it's actually expanded beyond big tech of late, because the number of mentions that artificial intelligence that were never mentioned before by many, many companies is now starting to come up in many calls. And I think we'll hear a lot more about it in this coming earnings season. So I don't give that much credence that, big tech is more defensive, because it's just driven on this recent narrative of AI.
How much, I don't want to say hate, but how much pushback do you get at a time when the market is rallying, when you say you kind of have to be conservative, I'm going to stick with that, look at the flashing signs, this isn't going to end well? How much do you get people calling you and saying, really, are we still doing this?
So I do get pushback, but if you take a longer term view, I think we can be comfortable. It's not that I avoid all tech. It's just that, I don't subscribe to this narrative that's been, overtaking the market, when the market is very, very top heavy, right? It's driven by 7 to 10 stocks. That's what driven all the performance this year. I'm looking at many other signals that I think, create some headwinds for not only the economy, but the market, in the coming months.
Like what?
So look, when we think about demand in the economy, so let's not conflate the two things. So I'm going to start with demand. When we look at student loans, those are starting up again. They're right now, they haven't been making payments for the past 3 years. And so those payments can be starting at anywhere from $300. I've seen numbers as high as $500 or $600 a month. That's going to curtail consumer spending. Furthermore, I look at things like new auto sales. The loans on new auto sales now, 17% of new loans are $1,000 or greater per month in terms of payments. So that curtails spending at the end of the day. And I think that that's going to be an issue for the economy in the coming months.
One thing that you noted in your research was a dependence on this idea that rate hikes are going to curtail some of the enthusiasm. And we've talked all morning about how a significant amount of hikes have been baked into the market actually over the past couple of months. And there hasn't been a response. There hasn't been a sell-off in risk assets. Some people view this as reason to continue to go into risk assets, that they are less susceptible to a sell-off driven by rate hikes. And other people say that, again, it's the ostrich syndrome, stick your head in the sand. Why do you think that it probably is more the latter than the former?
Well, look, I guess people just don't believe the Fed, perhaps. I mean, the Fed has been very consistent in their messaging, and it sounds like we'll hear more from Powell this week, but it sounds like there will be, more interest rate hikes, at least before the end of the year. And I believe them. And so I think that is something that the market has to be prepared for, and it is not pricing in now. And you can see that with this rally in AI. It's pushing it to the side and it's ignoring it. And I think that that's going to be an issue. And that's why, I think you should have an approach where you can be more defensive. It's not to avoid everything. It's not to take no market risk. It's just that you have to be cautious in these times, because you cannot time the market.
So let's talk about how you're defensive. How much have you increased your allocation to gold, considering that you view that as one area that will outperform?
Yeah, so we've owned gold now for the past 3 years or so, mainly driven by just thinking about the debasement of the dollar. You own gold because you want to hedge against the debasement of the dollar, or more importantly, and you mentioned this earlier in my notes, that people are worried about sovereign credit risk, and that's the thing that I worry about, and that's why we hold it. We've continued to add gold, throughout the interest rate cycle increasing in early 2022. We've continued to add to it. We still hold a position, and just look at the performance of gold. You wouldn't think that it would go up in the face of rising real interest rates, and that's because there's a fear that there's a sovereign credit risk out there, and that is something that I think is very real.
When you talk about sovereign credit risk, I suspect you're talking about the U.S. in particular, if that's a sort of offset to the dollar. How much are you trying to shift away from the U.S. despite some of the tech rally, especially if you don't believe it can continue?
Well, we have some international exposure, but it's not so much the U.S. I actually think you could have a situation, when you look at the balance of payments across different countries, different economies, I think that could create a sovereign credit issue away from the U.S. And then you could have a big issue. With the U.S., it's the fact that we have to issue $1 trillion in, after the debt ceiling passed, we have to issue $1 trillion in new debt in the next 3 to 4 months. And that's what's going to create pressure, I think, on the dollar over the next 3 or 4 months.
As you position some sort of allocation strategy that is defensive, still invested, but not defensive, can you talk about the 60-40 concept and how you're either depending on it or throwing it out and kind of betting on a new paradigm?
Yeah, I mean, the 60-40 thing, that's if you think of the 40% as being, long-term bonds, I think you can throw that out. But I think you want to have some balance. You can get a real return now in the bond market, and I think that is something that people should allocate to. We've held some cash, over the last few months as well, and I think that's also important because you can get a return on cash. But then, having an allocation to stocks, to income-producing real estate, to real assets, that's all going to be very important in the years ahead. Just to summarize it, we've been in a 40-year disinflationary environment. And this inflation that we've been experiencing doesn't go away in the matter of a year or 2 years.
You talk about how longer-term treasuries, for example, is not going to be a ballast for the portfolio. That's a pretty significant shift. How do you then pair that with the idea of real estate, with the idea of all the other instruments that are tied to those longer-term interest rates?
Well, with real estate, I think the best real estate investors fixed a lot of their liabilities over the last few years. I think if you were smart, they did that. And so I think you can have some advantage there. But look, anywhere where I think you have long-term interest rate risk, I think will be an issue for investors, I think, in the months, years ahead.
Patrick Verzetti, thank you so much for being with us. Really a pleasure to hear your thoughts. Right now, we are about 13 minutes into the open, and we are seeing the softness persist for a second straight day, deeper than yesterday, led by the NASDAQ, actually about the same with the NASDAQ and the S&P both lower by in and around 3 to 40 basis points lower. Russell 2000 continuing to get less love, and this is going to be one of the big questions as we head toward the second half of the year. How much do we see a broadening out of some of the rally that has really been much more focused on a couple of names? Coming up, Tesla CEO Elon Musk, one of those names, teasing more international expansion, this time in India.
I'm actually incredibly excited about the future of India. I think India has more promise than any large country in the world. I'm tentatively planning to visit India again next year.
That conversation coming up next. From New York, this is Bloomberg.
I am a fan of Modi, so I have to say that. He really cares about India because he's pushing us to make significant investments in India, which it is something that we intend to do, and we're just trying to figure out the right timing.
Tesla CEO Elon Musk meeting with Indian Prime Minister Modi yesterday about potential investment in the world's most populous country. Musk telling reporters, quote, "I'm confident that Tesla will be in India and will do so as soon as humanly possible. It's quite likely that there will be a significant investment, a relationship with India." His meeting with Modi coming after Musk was courted in recent weeks by other world leaders. Bloomberg's Ed Ludlow back with us for more. Ed, it seems like it's the global tour with Elon Musk. Why now?
Yeah. The thing is, the emphasis in that soundbite from Elon Musk, it is Modi pushing for the investments, and that's kind of the commonality in all the meetings that Musk has had with world leaders. They want him in their country, and Musk and Tesla hold their cards close to their chest. As he said in that soundbite, Tesla doesn't want to jump the gun on an announcement, but they do feel they'll make a significant investment in India at some point and be present in India. It's worth noting the Bloomberg reporting on what's happened in the last year. Talks between Tesla and India essentially restarted in May after having been on hold for a year because Musk and Modi's administration had some policy differences on the right way of entering a new market, which maybe we can dig into.
Well, yeah, and I do think that that's important to know. So what is exactly the considerations, especially at a time when the rally in Tesla shares has been one of the significant drivers, frankly, year to date in U.S. equities? I'm just doing the calculation right now, and we have seen a 122% rally in Tesla shares. Ed, what is the frugality? What is the logic between where to expand?
It sounds on that basis like Tesla's not valued as a car company, but it is a car company in the first instance. And so what happened a year ago in May 2022 is Musk was asked why he would enter India or why he hadn't. And he basically said that they will only be in a country where they're allowed to sell and service cars. The Modi administration did not want Tesla importing vehicles from the Shanghai plant. Tesla did not want a heavy tax or levy on those vehicles because India's average household income is different to that of the United States, right? They wanted to test out the market with sort of reasonably priced vehicles that were not amplified by the impact of taxes. The Modi administration kind of went a step further and said, look, you've got to build them here. So now, as Bloomberg's reported, the talks kind of center around local sourcing of components and what that would look like. And it's kind of a chicken and egg situation, but very positive. And you will note, Lisa, that since that meeting last night, both Modi, who is a big tweeter himself, and Elon Musk have tweeted at each other to share their respects after the meeting.
Such a Twitter love fest. Thank you so much. Meanwhile, we are less than 15 minutes, more about 10 minutes away from Fed Chair Jay Powell taking the helm at the House of Representatives in Washington, D.C. Back with us is Michael McKee of Bloomberg. Can you give us a sense of what to expect today versus tomorrow when he heads before the Senate?
Well, today will be the newsmaking day because it's the first day of questioning, and it's the day he delivers his opening statement, which, as we have noted, doesn't contain anything new. But members of Congress will be asking him about basically all the same issues that we'll hear tomorrow in the Senate. Where is inflation going? What's the possibility of recession? And when and if are you going to raise interest rates, and by how much? But the House tends to throw in more political questions as well. I would expect some on the budget deficit. Does he think that the budget deficit's out of control? Do we have to cut spending? Other sort of social policy, fiscal policy questions that, as usual, the Fed chair will decline to answer.
Mike, we talk about the politics of the Fed and how much pushback he might get about the goal of raising unemployment, of really loosening the labor market. How much do we expect to hear that tenor today based on the issue of inflation that still is a preeminent concern?
Well, I would be surprised if we didn't hear about it, but I would expect more tomorrow from the Senate because you have some people who've made that something of a crusade, and I'm thinking of Elizabeth Warren from Massachusetts in particular. She has argued that the Fed set a goal of throwing people out of work instead of just suggesting that unemployment might rise because of interest rates. And so she will probably lecture Chairman Powell again tomorrow, and others may join her in that. But I don't think that it's going to be something that is a major feature of either hearing.
Mike, thanks so much. Let's take a quick look at some of what's getting active in the equity market. Bloomberg's Abigail Doolittle parsing through. Abby, what do you have your eye on?
Well, not surprisingly here, Lisa, with the S&P 500 down for a third day in a row and right now down about 0.4%. Most sectors are lower, led by communication services down nearly 0.9%. We do have two sectors up modestly. Energy up by about 0.3%. Energy up ever so slightly. Let's take a look, though, at over the last 4 days because we have the SOX, that chip index, sliding. And this, of course, as you're discussing this possibility that the AI bubble or the AI mania could see some kind of consolidation. Well, they're starting at least.
Abigail, thank you so much. Coming up, the market-moving events that you need to be watching. That's next in our Trading Diary. This is Bloomberg. Time now for the Trading Diary. You need to be watching this week. At the top of the hour, Chair Powell testifying before the House Financial Services Committee. Thursday brings the Bank of England rate decision and Powell Senate testimony. Bank of England, very interesting after today's inflation data. We'll also get another round of jobless claims, plus U.S. existing home sales. And Fed speak galore from Waller, Bowman, Mestra, and Barkin. More Fed speak rounds out the week. Friday with Bullard and Bostic. We are, of course, watching for some Fed speak today, including Austin Goolsbee at about 12:30 p.m. today. Right now in the market, you can see a deterioration, particularly led by the Nasdaq, down almost 0.8% as the session grows older. S&P lower by about 0.5%, and the Russell actually doing better than expected. This was Countdown to the Open. This is Bloomberg.